Not a big deal. All right. Looks like we're live. All right. Well, thank you for joining me back on the Magic Internet Money podcast. Both Lyn Alden and Joseph Wang. Lyn Alden's if you're a Bitcoiner, you obviously know who Lyn Alden is. She's a macro analyst, and she's one of the best voices for educating people about Bitcoin. I feel, and that we got this last cycle. Always every cycle we have in Bitcoin, there's always a bunch of new, like, really influential and smart voices that come to Bitcoin and kind of educate the next wave of people that are trying to learn about it. Joseph Wang's also a former Fed trader that wrote the book Central Banking 101 that every Bitcoiner should at least attempt to read, maybe at least a summary of.
It's a great book. I recommend it.
Thanks, guys.
So last time, Joseph, you came on the podcast, and we talked a lot about the mechanics of central banking, how money works, and we briefly touched on Bitcoin at the end of the show, because I really love your work, and I love listening to you on podcasts. Whenever I hear you're on a podcast that I listen to, I make sure to plug it in. And one of the things I had heard, you were skeptical of Bitcoin, not from any sort of perspective of like, oh, that's a scam or that's a Ponzi scheme or anything like that. It was like more of like a concern that Bitcoin the governments will try to stop Bitcoin, or governments won't allow like a Bitcoin to basically succeed in a world where they can control so many of the endpoints and have so much control over money. So I wanted to have this conversation with Lyn and myself, so we could kind of just go through all the healthy skepticism that you have around Bitcoin, and maybe answer some of your questions, and hopefully let you see how sometimes some of the concerns a lot of macro folks have about Bitcoin maybe is not quite as big of a threat as they think it is.
Sounds great. I think a lot of people shared my concerns, and so I think it'd be a good way for everyone to learn more about how the Bitcoin community perceives these issues. I guess the first one is kind of obvious. I mean, recently, for example, what we see is that the New York Fed appears to be beta testing CBDCs with a consortium of U.S.-based banks. Now, I don't know if they're going to go through with this. It's ultimately going to be a political decision. But let's just say that one day there is going to be a US CBDC, and there will be a Euro CBDC, and so forth. How do you think the government handles these competitions? I mean, they wouldn't let, say, I know, the state of California issue their own currency, right? Would you think that the government would allow Bitcoin and other altcoins to exist if they had their own CBDC?
Lyn, you want to take that one, or
sure, I'll jump on it. I mean,
okay.
I think it depends on jurisdiction, right? I think that U.S., Europe, and China, for example, are different jurisdictions, different rule set, different law sets. And so in the United States, it's funny. In the 90s, there was this big kind of legal battle about encryption, right? And the inventor of certain types of encryption, wanted to put it out there. The U.S. tried to, sanction that from happening, and so he published it in a book. And it's kind of like, well, now it's speech, right? And so there was this whole, and you could like put it on like a T-shirt, and it became a thing. And it's actually one of those things where the U.S. government lost. I mean, they essentially did not want peer-to-peer encryption to be a thing. It became a thing, and it also became at the time it was phrased as like, I mean, who would want peer-to-peer encryption? Only bad people. Whereas of course now it's a key part of say securely paying for the credit card online. And so that's actually a precedent that shows that it can be pretty challenging to go hard against open source code and the ability to, it's essentially speech, right? And so there's obviously nuances around that. And so I think the United States is in a different position to some extent than even Europe, but then of course places like China. And there's also, I think part of it also depends on need, right? So for example, in the United States, we have among the more stable currencies, among the more robust payment systems. Most people don't feel a pressing need to get into Bitcoin or stable coins, whereas if you talk to someone in Argentina, stable coins and Bitcoin are just super obvious for them to want to hold. They don't want to hold dollars in the bank. They'd rather hold in an offshore entity and basically have those tokens, and they'd rather have Bitcoin. And so I think it really comes down to, if we get to a point where CBDCs are launched and they do start, say, censoring things, I think that's a whole nother vector, a whole nother kind of reasoning argument why some people might want Bitcoin, right? And so right now, kind of the big argument is, look, you can self-custody it. Its supply growth rate is similar to gold, and it's going to keep shrinking, while fiat currency XYZ is going to keep inflating in supply. And so over the very long arc of time, you'd expect it to appreciate. That's kind of the main argument, but I think that can shift more towards an anti-censorship role, which is one of its original purposes, if that becomes more prevalent. And the last example I would point out is that, for example, in Nigeria, they have one of the highest Bitcoin and crypto adoptions in the world. I say crypto just because sometimes those ways of measuring it, like Chainalysis will do like the crypto adoption index, and they don't necessarily break it out by coin type, but certainly Bitcoin is a very big percentage of that. So Nigeria has one of the highest Bitcoin crypto adoptions in the world, and they've actually severed it from their banking system. So they've not banned it, but they have made it so that banks can't, say, send money to crypto exchanges. So the on ramps are essentially cut off, and yet despite that, it still has very high adoption. And it's partially that combination of people recognize the need more because you have higher inflation. There was a wave of bank accounts being frozen for protesters and things like that. So there's more of an awareness there of why they'd want to hold, say, Bitcoin or stable coins and things like that. I've talked to a number of people there to kind of, hear their story, and it shows that if there's a will, there's a way. Basically, people will trade peer to peer if they perceive the problem as being significant enough to do so, which is, it obviously depends on jurisdiction, to the extent of censorship, the extent of inflation, that kind of thing.
I've heard that there's been a lot of advancements in the speed of Bitcoin transactions and so forth. Is that continue to be the case? I mean, I think earlier on when people were talking about paying with Bitcoin, they were complaining about one, the transaction fees, and two, every time you had to buy something, it took a while. But I also heard someone say that they've really changed that a lot, so it's not a problem anymore. Is that true?
Yeah, so it's basically they probably referring to the Lightning Network. And so kind of like how the US financial system is stacked, and of course you know this better than anyone else, you have, say, Fedwire, and then you have faster payment systems that run on top of that and get it settled, between banks, gross settlement. Bitcoin's kind of developing in that direction, where in the beginning, you have Bitcoin, it's got 10-minute block times on average. Sometimes blocks are shorter, sometimes they're longer. If you're doing larger transactions, you might want to wait for a number of blocks. And so it's pretty inefficient in-person payment tech. It's good for, like, online payments where speed's not a big deal, or settlement where it settles faster than existing, say, banking settlements do, because you can settle in a half hour, even with a $1 billion transaction, for example. So it's efficient as a settlement network, but not as like a pay for coffee network. And what Lightning does, it was the groundwork for that was laid back in 2015. It was able to go live after the 2017 SegWit update. And so the kind of the early implementations and usable network really started to come out in 2018. And I would say they kind of hit critical mass in, say, late 2020, early 2021, where you kind of need more liquidity for that network to work. And so the past couple of years, that started to work pretty well. And so if you're doing small payments with Bitcoin, the type you might actually want to do in person, up to $50 or $100, or in many cases $200, those will settle as fast as a credit card transaction now, basically within seconds.
Joseph, also to go back to the kind of like the government CBDC conversation a little bit too. I mean, from first principles, you should look at Bitcoin as a technology, and it's kind of confusing because it's BTC is the asset, the coin, if you want to think about it like that. But Bitcoin, the network, is a technology, and it's more akin to like BitTorrent, where it's illegal currently to file, share files if it's copyrighted material. You can't pirate movies, and there was a whole battle around that. But the difference between the Napster versus BitTorrent story is that Napster was centralized and BitTorrent was decentralized. So when there's millions of people actually running the software, even though the government and the record labels and Hollywood tried to stop people from pirating, they didn't. They weren't able to. It actually just drove people more to pirate because more people started downloading the software and running the software, and enforcement of those rules becomes really impossible when millions of people are running the software, unless you do like censorship at the internet level. And even that you can get around with certain like VPNs and different peer-to-peer protocol, messaging protocol technology, things like that. So, but anyways, BitTorrent was unable to be shut down by the government. What they had to do in the end was just compete with BitTorrent and make Netflix. Like they created a way to make a better product that people would cause people to want to stop going through the hassle of using as alternative technology to get this benefit and use Netflix. And so Netflix was kind of, you could think of, I guess, as a CBDC. If they actually make a CBDC that's got properties that make it better than Bitcoin, then maybe that's a threat to Bitcoin and maybe people will use Bitcoin less. But I mean, that's the only reason that I could think that Bitcoin adoption will be hurt by a CBDC, is if they actually try to compete with the properties of Bitcoin with their CBDC. But based on everything that I've heard them saying, it's kind of looking like it'll end up being more like surveillance and capital controls and things like that. Does that make sense?
So let's say that let's say that Bitcoin is the network improves so that it becomes more usable, and let's say that the network is resilient, like the torrents you suggested, that it can't easily be censored. What role do you two envision Bitcoin playing in the financial system? Will it be another asset like gold or silver, or do you envision it actually becoming more of a currency that people would actually use in their transactions in day to day?
Lynn, you want to take that one?
Sure, I'll jump on. I mean, so the short answer is I don't know yet. I think it's going to take time. I think we have to kind of look. You can envision far out in the future of different possibilities. But I think when you start to kind of just describe how you think things will look multiple steps in advance, you're kind of getting ahead of yourself. It's like, like first Bitcoin's got to stay over $a few trillion before you talk about anything past that, right? So it's like first get half as big as gold, then get as big as gold. We'll see what happens from there, right? And so I think I think it starts out as an alternative asset. That's kind of where it's been for the past 14 years now almost, where it's this alternative that people can have. And some of the pros and cons versus gold. I mean, obviously gold can work offline. Gold's got the long history. The advantage of something like Bitcoin is that you can have Bitcoin, you can memorize 12 words, and you can travel, you can go anywhere in the world, and you could reconstruct your ability to access your Bitcoin, as long as you either wrote those words down or memorized them, or had a little memory stick with them, or however whatever the security needs mandate. And so that's kind of a useful. It's almost like money in a decentralized cloud, right? That you can then bring around with you, which is, I think, a pretty novel introduction. And another way that I phrase it is that, prior to Bitcoin, there wasn't really a way to send peer-to-peer money long distances, right? Obviously, cash in person or any sort of other kind of exchange goods could work in person. But if you wanted to send money internationally or even across the large country, you had to go through the banking system to do it, and therefore you could get told no. There's various ways to limit that or control that, other than just stuffing some envelope, like money in an envelope or something, which you can do in tiny amounts. You're not really supposed to. But anyway, Bitcoin basically comes along and says, well, here's a way to do peer-to-peer transfers. And then especially when you start adding things like the Lightning Network, and then there's kind of layers around it. So there's also, for example, Cash App, where it's custodial, but then when you have you can send some to someone else's like Cash App account like instantly. And of course, that's only using their internal ledger, right? But then it also connects to the Lightning Network and to the broader Bitcoin network. And so you have this kind of like area where you can have super fast transactions in there, and you're not actually fully using the Bitcoin base layer, even though they're holding Bitcoin on your behalf. Or it's an open network that you can then connect to other ecosystems that say do connect to the Lightning Network. And so I kind of envision it like that, where, if more people choose to use it, I think there's kind of a full stack, from the base layer up to the middle layers and up to the certain, in some context, custodial layers, where people very much could use it as a transaction medium. And I think it kind of starts in more of the periphery countries. Like I mentioned Argentina before, but there are dozens of countries in the world, probably 100 countries in the world where they just don't have a very good currency. It's like, I think one can back up and question, does the world need like 180 currencies or whatever the number is right now? It's a very large number, and most of them are not saleable outside of their own small little area. They're basically their local monopoly. Um, Bitcoin's becoming one where, and I was actually talking to George Selgin about this on Twitter. We were kind of having a discussion that if you travel internationally, there's only a handful of monies that are pretty saleable, right? If you bring physical dollars, you can get someone to take them off your hands pretty easily. If you have some, gold Krugerrands or gold Eagles, you can get someone to take them off your hands pretty easily. Depending on where you are, if you have euros, Swiss franc, there are a number of assets that you could, they're pretty saleable. They're pretty easy to either buy something with or at least find someone that you can exchange pretty readily without, a nightmare. Whereas, for example, if I have, and I literally do, I have Egyptian pounds right in this door here, and I'm in New Jersey, and I don't even know where I would start trying to exchange them for something. Like the local banks wouldn't do it. I'd have to find a specific way to convert that. It'd be kind of a mess. And Bitcoin, especially in urban centers worldwide, is becoming one of those more saleable goods internationally, where in any one country it's not a very dense network, right? So you can't necessarily pay for a lot of things in Bitcoin as you can in your local currency, but it's becoming one of those international assets where if you go to many places in the world, it's one of the more saleable goods when you include, ATMs that you could convert to the local currency, various ways that you could find a buyer. There's multiple vendors that will just accept it outright. And so it's kind of becoming one of those international assets that I think is increasingly usable as kind of a international medium. And it's kind of like it's everyone's kind of backup option. I mean, one of the first use cases for it, even before the Silk Road, was when WikiLeaks got deplatformed. I mean, this was, I think, back in 2010. WikiLeaks got deplatformed from PayPal and other payment providers, and people turned to using Bitcoin, right? And so it's kind of like some of the layers recently make it as efficient as credit cards. So some people just like the UX now. But even aside from that, it's kind of always there as people's like backup option or one of their tools that they can use.
I think that's a really good point that Bitcoin is actually better than some of the emerging market currencies. I mean, I know that just by traveling through the world, that sometimes you could actually see like proper Bitcoin kiosks or things like that in major cities. You never see a kiosk where you could exchange Egyptian pounds or I don't know, like say Argentine pesos for dollars, but you could do that for Bitcoin sometimes. But let's say that you are actually someone who has money and you want to keep some of it in Bitcoin. It seems to me that one of the biggest problems for Bitcoin, and it's also both a problem and a benefit, is its tremendous volatility. Now, if I want to diversify my assets into Bitcoin, it's very volatile, and one day I could be very well off, and a few months later I could be much less well off. Now, that's not
Too
very good.
soon. Too soon, Joseph.
Maybe one day I'll become very well off again. So that's a problem for a lot of people who are, I guess, in the more institutional space. But on the other hand, it's also a feature for many people because having it volatile, it makes it possible for a lot of people to make a lot of, I guess, fiat in a very short amount of time, and I think that's been very helpful for its adoption. Now, how do you to go make that balance going forward? I mean, do you think that one day Bitcoin will become less volatile? And if it doesn't, I mean, at one point, does that hinder its adoption rather than help? Because eventually you're going to need more institutional investors. You can't have people just hodling it or, I don't know, YOLOing it all the time. That's not where most of the money in the world is.
So I'll jump in. Maybe Brad has a different answer, but and this is sometimes where I see things a little bit differently than other Bitcoiners. Like, and it's not just institutional; it's also people in emerging markets, right? If you don't have a big buffer between your income and your expenses, you have to be careful holding volatile assets. And so that's one reason I've been more favorable on stable coins, uh, alongside Bitcoin. Kind of like you can almost view them like as a checking account versus savings account. If you need stable value for the next 12 months, stable coins are interesting in certain jurisdictions. And if you want to, hold something longer term, that's where Bitcoin's interesting. Basically, I would view it as like doing fundamental analysis on on the network. So you're looking at network effects, and you're also looking at, say, currency fundamentals. What is the expected supply growth of the asset? What are the properties? What's happening with the UX over time? Is this something that I'm willing to hold? And for me, it just comes down to position sizing, right? So obviously there are some people that are well known for just being all in, whereas I don't view any kind of technology as something that, you know, most people would want to go all into. And so it becomes, you know, a non-zero number, which I think can vary based on how long someone's been researching it, what they think about it. You know, they can dial that number up to a thing that makes sense for them. I do think over time it'll get less volatile, because I think part of its volatility is its newness, and that people are still trying to figure out, you know, a lot of people still don't know the details of how it works. They still don't know the difference between, say, Bitcoin and other digital assets. And then two, any sort of volatile asset attracts leverage, unfortunately. Where if someone, you know, if they think it can go up 10x, and like, well, I can buy this on debt and go up 100x, and then of course they get liquidated and wrecked, and then that adds to downward volatility. So basically, as prices fall, there's like forced sellers that are like even exacerbating it. And then there's other things, like there's no like wash sale. So people, if they're down, they can like sell and further lock in like tax losses and stuff like that. So there's kind of multiple incentives once it already fell, to then even like kind of make it worse, whether it's leverage or other things like that. And I think part of that comes just through wider adoption, right? If you know, if 1,000 people hold an asset, and one of them's like a millionaire, you know, that millionaire can move that price of that asset probably pretty substantially, just by that one person choosing to sell it, or one entity, one corporate entity, for example. But if that asset's held by 1 million people or 1 billion people, it's much more widely distributed, it's much more liquid, and so it's much harder for any sort of group of entities to do it. And then as it gets kind of, and again, this is supposing it's successful, if it were to reach a pretty wide ownership globally, where like, you know, a substantial number of people own a non-zero amount of it and they find it useful. And again, we have to think about an international context where many people do have troubled currencies. But as more people hold it, um, it's kind of like a lot of the gains are now behind it, and then there's less reason to leverage it, right? So people don't make these huge levered long bets on gold very often. It's not a huge part of that market. And so you don't see as much volatility in the gold space as you do in the Bitcoin space, in part because it's much more widely held alternative asset. And so I kind of see it sort of going along that approach, where it becomes more gold-like in the long run.
Joseph, 2 points, one on the stable coins and one on the volatility. I've been in Bitcoin since 2011, and I bought my first Bitcoin at $10, and I was mining it with my gaming computer. I still have it over there in the corner, because one day I might try to hire somebody to see if there's some Bitcoins on there that I forgot about or something. There could be. I looked at it myself. I didn't find any, but maybe there is. I'd probably not, but you never know. But I was like that type of person that bought Bitcoin as a savings technology back in 2011. I was an entrepreneur in the Facebook game business. I was making Facebook games, and I had some extra money coming in. I was listening to people like Peter Schiff and Robert Kiyosaki and different folks that were trying to educate me about the way that the money system is just continually debased over time. So I started looking at gold and silver as a way to treat like a portion of my savings as like a long-term retirement bet, that I'm going to protect my wealth in gold and silver. I found my way to Bitcoin through somebody who was also talking about this digital form of gold, this Bitcoin that has properties modeled after gold, but it's digital scarcity. And if we're going into a digital future, then it would make sense that there's a digital form of gold that has provable scarcity, decentralization, censorship resistance, like Lyn was talking about with WikiLeaks. And so I bought some Bitcoin. I didn't go all in on Bitcoin or anything, but as the cycles progressed, I mean, I lost Bitcoin along the way. I sold half my Bitcoin at $30 because I wasn't a trader. I wasn't a risk manager. I was just, I guess I'm supposed to do this. Like, you know, I made some money on this trade. You know, I was right about Bitcoin. I sold half of it. And then I lost a bunch in an exchange that went down in Mt. Gox in 2014 or so, after it had risen like 100x. I took on counterparty risk, and you know, there's volatility that wipes a lot of us early people out, because like Lyn was saying, you use leverage or you don't know about counterparty risk. And in the early days of Bitcoin, especially, like a lot of us learned lessons of don't trust, verify, which is like, don't trust what the insiders say. Don't, Bitcoin was invented for a reason, for you to be able to sovereignly control your own wealth, for you to actually run the node, hold your own keys. There's no need for you really, if you're just an individual and you're, say, going to put 5% of your net worth in Bitcoin, there's no need for you to really trust an exchange or a crypto bank or something like that with your money. As we've seen with FTX and some of these other Wildcat Bank sort of crypto casinos blow up over the last 6 months, Bitcoiners like myself and probably Lyn and others that have learned the lessons of the past of don't keep your money on these exchanges, don't use high leverage, practice proper position sizing and risk management. We have been advising everybody pretty conservative. Maybe Michael Saylor got a little over his skis with the advice to like take on too much debt, but he's a noob, so we'll forgive him for that, I guess. But most of us have a consistent message of 5%, maybe, like 5% of your net worth as a savings in Bitcoin, and hold it for the long term over 10 years or more. Because if Bitcoin does what we think it's going to do in terms of a digital gold or a digital property store of value that can potentially become a global reserve asset in the next decade or two or 3 or 4, then it's going to be up in the 10 to 20 trillion dollar market cap range, competing with gold and property and US bonds and things as a form of a digital reserve asset for countries that are cut out of SWIFT and countries that are cut out of the US hegemonic sort of equation. So you will see sovereigns and pensions and hedge funds and countries even at some point. I mean, you will see, but if you see that where we think Bitcoin could go to in 10, 20 years, that 5% of your net worth will become 100% of your net worth. So for most of us in the early days, I mean, that's what happened. Even though we lost Bitcoin and we were kind of like the pioneers going through the Oregon Trail to try to get to the prairie and stake our claim of land, like we got attacked by gangrene and squirrels and whatever, and we fell off the wagon, lost a leg. I mean, I'm still limping around, but like Bitcoin became at one point like nearly 100% of my net worth, just because of how volatile it is. So Michael Saylor had this term last year that I heard. I don't watch everything he does or anything like that, but it's hard to miss his highlight reels. So he had this saying that was you can have volatility, or you can have vitality through volatility, or stagnation through stability. And that really resonated with me, because holding Bitcoin for 12 years now, or 11 years now, it's been a tough ride. I feel like I've lived a whole person's investment life. I feel like I'm a 70-year-old man that's been dollar cost averaging into the S&P 500 since like 1930. And like, I've seen every single crash. Like, I felt like I lived through Black Monday and Black Thursday and the .com crash, and because I've been holding Bitcoin through these crazy volatile movements. But I'm very convicted on where I think this is going to eventually go. So it does have an effect on you for sure. I mean, I've got a lot of white in my beard now, probably prematurely because of all this Bitcoin volatility. But I think it's been worth it for what's ended up becoming a life-changing thing for me to recognize the value of this. And then find, as Bitcoin grows, you get more thought leaders and more influencers and educators like Lyn and Preston Pish and folks like that, who are macro thinkers, and they're not just like gold bug anarchists, libertarians that are saying like, go all in on Bitcoin and everything else is a scam. I mean, they're giving rational, reasonable advice for people to like protect their wealth in different ways, and take some risk off the table and practice position sizing. And so I think Bitcoin volatility, actually, for the average person, if you start with, say, a 5% allocation, and you don't think about it like a trade, you think about it like a long-term retirement hedge or diversification, and ignore all the rest of the crypto stuff, and don't try to become a VC or a trader or anything like that. Just literally save in Bitcoin for 10, 20 years. The volatility won't affect you as much if you can manage to disconnect yourself from the trading, sort of like, oh, I got to trade this thing, because it will, I mean, it should, if it's going to do what we think it will do, it should have another, I don't know, what are we at now? 16,000. It should have another 50x or something in it over, by the time it becomes a global reserve asset, one of many or a few global reserve assets. So, and if it goes to zero, then, that 5% of your net worth that you allocated to Bitcoin in a dollar cost average strategy is not going to actually negatively affect you that much. It's going to suck if you lose 5% of your net worth. It's not going to change your life. But that 5%, if it does what we think it's going to do, it will materially affect your life and change it for the better. So that's the advice that I give, and I know a lot of Bitcoiners give. Like some Bitcoiners get a little bit ahead of themselves, and like it's actually a minority of people that say like you got to go all in Bitcoin. Everything is a complete scam except Bitcoin. I mean, myself, I used to think that 10 years ago when I first got into Bitcoin. I was like, oh, everything's a scam. The stock market's a scam. Everything's a Ponzi scheme. I got to buy gold and Bitcoin. But as you get older and you kind of like learn more about the way the system works, I think you become more conservative, and it's almost like a sin in some Bitcoin circles to like sell Bitcoin. But obviously, if you can analyze that the macro trend right now is that risk assets are going to get crushed, it's smart, prudent, and conservative behavior to like hedge some of that risk away and sell some Bitcoin and still keep your long-term position if you're like heavily in Bitcoin. But most people, 99% or so of the people in the world, have no allocation to Bitcoin. So the advice that like somebody like myself, whose majority of my net worth still is in Bitcoin, is different than somebody who I would, like yourself, who maybe, or somebody from any circle that's looking into allocating to Bitcoin. It's more like there's a difference between the risk of holding the majority of your net worth in Bitcoin versus the risk of potentially gaining the benefits of what's going to happen over the next 10, 20 years. So yeah, it doesn't make sense to tell people don't buy Bitcoin now, even though there's a risk that Bitcoin could drop 50% from here because of macro and because of the trend that Lyn was describing. I think it's actually still really good advice to tell people to keep allocating to Bitcoin and keep buying Bitcoin. And these prices are actually good for somebody who doesn't have already a lot of Bitcoin. Does that make sense?
Yeah, I guess I'll just come clean and say, guys, I don't have any Bitcoin. Now, no, wait, keep listening. Now, one of the reasons that I
Broadcast
don't
over.
is that, I think they're gonna. So when I file taxes, one of the things that you see is that, do you trade Bitcoin? And if you do, the IRS is hiring like 80,000 people, new agents. I get the sense they're going to come down hard on anyone who owns Bitcoin, and I don't think anyone wants the hassle of being audited because they own cryptocurrencies or things like that. And so that's kind of a huge, I think, disincentive for people, for myself, and I imagine some others as well. But more broadly to this point, though, I think of the cryptocurrency space as a hedge against the fiat space, which I think some people in the cryptocurrency space share. But if you have to report everything and everything is dependent upon the I guess the assent of the fiat currency authorities, doesn't that kind of dampen the allure a lot? And so when I think about cryptocurrencies, it seems like just as Bitcoin is a technology, and technologies are always changing, so there will be new technologies to replace it that are better at it. One of the things that come to mind is like these real, true privacy coins like Monero, and I'm sure there'll be others like it who can survive, basically, let's say investigations or audits and things like that, simply because you can't see it at all. Now, what do you think is, I mean, do you see these altcoins becoming more popular? I mean, Bitcoin is technology and technologies get old, right? We don't use the computers that we used 10 years ago. Do you think that there will be competitors that emerge and become more prominent than Bitcoin? I mean, we have Ether, which is the second largest, and I don't know as much about that at all. It's more of a platform, it seems. But Bitcoin has this huge first mover advantage where it has name recognition, a lot of people holding it, but eventually it won't have the best technology, and there may be more technology that's more resistant to things like censorship and so forth. And if
So,
that happens, though,
sorry.
isn't that going to affect the value of Bitcoin a lot?
I
Well,
think that if
there's two questions there. I'm curious, Lyn, before you go on to the altcoin question, the tax question. I don't have this. I'm in Canada, so I haven't heard that before for people. So I'm wondering, like, what's your thoughts there? Is that really a disincentive, do you think, for people to buy Bitcoin because they see that tax, that box you have to check? Have you traded Bitcoin?
is that directed at me?
Yeah.
I mean, I think it's a good point. I do think that they do want to know who owns it, and that if they find out someone was trading it and not paying taxes on it, um, now they can go back and say, hey, you checked no, but you have it, so you lied on your tax form, right? So they're basically pulling more people into that transparency net. So I do think that's a risk. But again, I think of it in terms of a global asset, right? And so like, for example, you pointed out in Canada, you don't have that issue currently. In the United States, you are increasingly having that issue. But then it also comes down to, if you keep your taxes streamlined, you can survive an audit. It's definitely an incentive to. I would recommend that Bitcoiners be pretty buttoned up in terms of their tax situation so that they can survive that sort of pushback. I think it's certainly not going to be easy, I think, in the long run. I think there are a number of people in the Bitcoin space that have expected and are continuing to expect pushbacks from the government, or certain governments. There have been some governments that say try to ban it and then walk it back, like India kind of flip-flopped on what they want to do with Bitcoin over the past few years, because they kind of realized that, they can't ban Bitcoin, they can ban themselves from the Bitcoin network. And even then, it only works partially, right? So, for example, China is one of the more draconian countries in the world. They banned Bitcoin mining. There's still Bitcoin mining there, right? And it's, let alone Bitcoin holders and developers and things like that. It's pretty remarkable how it's pretty sticky in a lot of these countries that are even pretty draconian, let alone, I think, what the United States is legally capable of doing. To the altcoin question, that is something that was actually my first ever risk. Like, for example, I've been analyzing Bitcoin for a much longer time than I've owned it. And part of what kept turning me off, I was like, well, why can't, Ethereum take market share? Why can't XYZ token take market share? If they're going to make a million of these things anyway, why don't they all just get diluted? So it's something that I had to research quite a bit until I concluded that I think Bitcoin is the long-term winner here. And it's more so than just branding and first mover advantage, although that does matter. It's also about the specific design itself. So what most altcoins do is they sacrifice some degree of decentralization in order to achieve some other purpose, right? So, for example, if you make the node, so part of the way Bitcoin is kind of designed is to be as small, as tight as possible so that everybody can run a node, right? So you can run a node on a laptop, for example. Whereas it's harder to run, say, an Ethereum node. It's a harder to sync it, more bandwidth. You can't run it on Tor in the same way you can with Bitcoin. And then when you scale up from there into something like, say, Solana, it's virtually impossible for a normal person to run a node. You need basically a data center to run a node. And so there's a lot of kind of trade-offs that a lot of these other coins make in terms of achieving either bigger throughput on the base layer, more expressivity, like smart contracts right on the base layer, and including things like privacy right in the base layer. Whereas, say, for example, in Bitcoin, the approach instead is to do privacy on higher layers. Lightning is a little bit more private than the base layer, for example, and there's technologies to make it more private over time. There are now things like fediments that might come and help further enhance the privacy of the network. And when we look at, say, the evolution of technology over time, while it is true that, say, an old TV or an old computer that gets old very quickly, we don't use it anymore. When we look at, like, network protocols, they tend to stay around for a very long time. So, for example, Ethernet is like, 40, 50 years old. TCP/IP, was invented by DARPA decades ago. We still use the same kind of underlying technology for the internet. USB's been around for over 25 years now. It's on it's USB 3.0. It's basically, with these technologies, you kind of do these backward compatible updates over time so that, USB is not getting outcompeted by some new thing instead of it's getting outcompeted by another USB, a faster USB. And so even though Bitcoin, one of its properties that it is very, very hard to change, it is capable of doing backwards compatible updates. And so, for example, the 2017 SegWit update is what allowed Lightning to work. late last year, actually almost exactly a year ago, it did the Taproot update, which was another kind of, it's like a small refinement that added some efficiencies and a little bit of privacy benefits to the network. And it's a backwards compatible update. And so the design, like overall design space, I would say, in order to make a digital currency that is small and tight enough for a person to run a node is just kind of a limited design space. And I think Bitcoin's kind of capable of maintaining that, allocation or that position, even in a pretty highly competitive market. And it's kind of like the combination of network effects, first mover advantage. If you copy it, you're already at a disadvantage because you have less security. It's like if I tried to take Wikipedia, like I use this example sometimes. I could take Wikipedia, that you can just download all of it, and I could host it on my website. And then the question is, would I get anywhere near the traffic or usage of the real Wikipedia? And of course, the answer is no, because even though I can copy Wikipedia, I can't copy all the links that point to the real Wikipedia. I can't copy like the army of volunteers they have on the real Wikipedia. So mine would quickly be like an empty, less updated version. And so it would just fall away. And I think that's mostly what we see in the kind of the altcoin space. I think it's natural that people are going to experiment and see what's going to stick, if anything. But I don't really see much of a risk for Bitcoin itself being dislocated at the main thing it's trying to do, which is basically be decentralized money.
Joseph's like specifically, and that was a really great point, Lyn, and specifically talking about privacy coins, Monero, Zcash, things like that. While they do have these interesting privacy benefits like shielded transactions and Zcash and confidential transactions and things like that, there's a little bit of a logical fallacy that altcoin promoters use when they talk about this, because if you got to think that the government is going to be adversarial towards cryptocurrencies and that Bitcoin is a pseudonymous cryptocurrency, so that you don't quite have as much privacy as you would have with using something like Zcash or Monero, then in that world where there's a lot of scrutiny, you actually are most likely going to cause yourself more problems by choosing a coin that's specifically designed for privacy maximization, because you're basically opting into an audit at that point. Like you're basically saying, yeah, I'm doing this because I'm choosing privacy over the investment thesis. And that's not necessarily like a smart choice. For if you game theory that out, then they will see, okay, well, we're going to just go after everybody that's choosing Zcash and Monero, because I think it was like 2% of all the transactions on Zcash are shielded. So, if somebody's using Zcash shielded transactions, it's like they're opting in for that specific feature, which will make them even more suspicious of like, why are you using that? And also Monero, like the way that it works, it's technically not scalable like Bitcoin is, because it's harder to, it's if that was the coin that was adopted by market participants that are trying to do transactions with, the size of the blockchain would grow so big. Like Lyn said, it sacrifices decentralization for certain other features like privacy. And like that, I think, though, I'm not like against Zcash or Monero or anything like that. I just think for two reasons it's not a good choice. First, for that reason I just described, you're actually like opting into to the rubber glove treatment if you're choosing these over Bitcoin, which is a pseudonymous cryptocurrency, not completely anonymous, not completely transparent. It's like a Goldilocks zone. And the second is, you can use these things as tools. It doesn't stop them from being used. If you really want to protect your privacy, there's ways to use Bitcoin with coin joins or pay to endpoint, like merchant coin pooling. You can actually use, if you're really trying to use these tools, there is ways to use them to retain your privacy and still, you don't. It's a touchy subject for people because they're like, oh, don't talk about that because then you're giving money laundering advice or something like that. But a lot of us just believe that, like, you deserve privacy, and there's ways to use Bitcoin where you can retain your privacy. And like the perfect example of why it's completely reasonable to advise people to like think about their privacy is Executive Order 6102 that happened in the 1930s with FDR basically saying it was illegal to own gold. And I learned recently, probably a year ago, that it was only about 50% of Americans that complied with Executive Order 6102. And it was mostly all the folks that had their gold at the banks or with trusts and stuff. If you had your gold in a vault in the bank, there's nothing you can do, because when that happened, they just had to seize everything. If you had your gold at home, in your safe, or buried in the backyard or whatever, you could just wait that out and you didn't have to comply, or you could even still keep using it. So back then when that happened, it was more of a, I believe, like it was more of a political incentive to stop Americans from redeeming their dollars for gold. Like they didn't want to actually see a run on the gold reserves because they were printing money and it was backed by gold at the time. So that was like a more of a political game theory move for them to stop ownership of gold. Right now, I don't think there's a risk of a 6102 style attack on Bitcoin or any cryptocurrency, because there's not the same pressures. Like you can't redeem your dollar bills for Bitcoin. so I just think it's unlikely to see the government really turn against it that much. I think more so what you're going to see is they just want to enforce the banking laws. They want to enforce AML KYC. They want to have the travel rule applied. They don't want to see money laundering. They don't want to see Russia be able to evade sanctions using cryptocurrencies. So for sure they want to enforce sanctions and things like that, but they're more so taking action against specific things like Tornado Cash on Ethereum, which was a way for hackers and money launderers and even, normal people that just wanted privacy on Ethereum. But majority of the usage of Tornado Cash was to wash money through the Ethereum system and be able to like escape with their ill-gotten gains out the other end. So they sanctioned that. The Treasury put an OFAC sanction on that protocol, and the Ethereum, one of the main companies that develops Ethereum is Consensus. Consensus is owned by Joe Lubin. He's one of the co-founders of Ethereum. UBS Bank and JP Morgan and other banks have invested in Consensus, and Consensus controls MetaMask, which is the main wallet that people use to interact with Ethereum, and Infura, which is what Lyn was saying, the node software. Basically, on the Bitcoin system, we maximize run your own node as a piece of advice. Like that's decentralization, the ability for you to run your own node and have that resilience against government clampdown is what's core to Bitcoin's ethos. But on Ethereum, that's not really something that they talk about very much, and it's actually not even possible for most people technically to run their own node. You have to kind of be specialized. And so therefore most of the transactions go through the nodes that Consensus runs. And it was this company called Infura, which does like cloud nodes, but then Consensus just bought Infura. And so now they own MetaMask and Infura, and 99% of all Ethereum transactions go through MetaMask and Infura. So they enforce the OFAC sanctions. That company basically restricted access to the Tornado Cash protocol once OFAC sanctions were applied to it.
Even if you were not American, that's right. So they basically extended the reach of U.S. sanctions because they even applied it to people that I think are not American and that wouldn't otherwise be subject to those sanctions.
So we're already kind of seeing this play out. There's been, it's for anybody that's really paying close attention, it's pretty obvious that systems like Ethereum are in compliance with surveillance goals and AML KYC goals, and most of it's propped up by US based VCs, and they have like publicly identifiable founders that can be pressured and hauled into Congress and sent to prison. So they've all printed tons of money over the last year in this bubble, and none of them want to actually do the cypherpunk protest against privacy intrusions. So then they're not going to actually like go to jail to stand up for privacy or decentralization. They've made so much money that they're just going to comply. We already see it all over Ethereum DeFi that compliance is just baked in right now. So, I mean, it's a little bit of a kind of like a longer deep dive into that. I won't go further. I think I went a little too far.
I'll jump in. I'll jump in real quick. So I mean, I think Joseph asked really good questions. For example, it's the same questions I asked, and it's the same questions that I still ask. I mean, I think it's important to continue to ask questions about the network, to constantly assess risks to the network. And so I think those are the right questions to ask. And when it comes to privacy coins, it's, you know, I'm more sympathetic to those coins than I am to many other coins in the ecosystem. I think some of them are well intentioned, and they're, you know, they're trying to stick to kind of the cypherpunk ethos. But as Brad pointed out, there are scalability issues with privacy. There's also, and as you point out, there's kind of a game theory challenge where privacy coins have a tougher time getting listed on exchanges than other coins of their size, because it's kind of just viewed as like a sketchy coin. Which, you know, ironically, I think it's actually they're some of the least bad coins out there. I think because there's actually a demand for that, but they're kind of more associated with criminality, for that reason. If something's privacy first, people kind of assume that it's criminality first, even though I don't think that's fair, but it just is the reality of things. And so I think that you're basically sacrificing scalability, some degree of auditability as well. So it's harder, for example, to audit the supply of Monero and assure that there's no sort of inflation bug or anything compared to what you can do in Bitcoin. And when you're, you know, if you're a small user that wants to hold it for 2 hours, maybe you don't care. But if you're an institution, like there are insurance companies, like say Mass Mutual, that will put, you know, 100 million in a Bitcoin, which is tiny compared to their, like, you know, $1 trillion balance sheet, but they'll put scale into Bitcoin. uh, they want to, you know, the fact that it's like the most audible, of the cryptocurrencies is important to them, right? That there's basically that there's much less of a chance of an undetected inflation bug or something like that compared to some of these other more private coins.
You two make some great points. It's a lot to think about, and I can tell, uh, you two have spent a lot of time thinking about this problem and have studied it extensively. So that's all very helpful for me, and I'm sure the audience as well. But I also think one other thing about this, though, is that, you know, this has been framed as an investment so far, and in any investment thesis, you have to know when you're wrong and when you have to get out. So I noticed that many people who in the space are very passionate for this, and that's can be very good, but also very dangerous because then you don't actually see when you're wrong and when you have to get out. Now, this is going to be a hard question. What would you see? What would you have to see to that would change your mind about Bitcoin?
So I'll no, you want to go first? You want me to go
And
first?
you can go.
So I would say one would be some sort of, I think, destructive change, right? If it went in, if one of these updates went in a direction that I thought was particularly bad or that somehow broke the protocol, and then maybe you have like some sort of chain split, and then it just kind of it doesn't, the community gets split and sort of crippled, and some of the network effects are disrupted. That would be, I think, pretty bad. I think it's one of those things where Pandora's box has been opened. So this is a technology now that is always has the potential to exist, and it can even change form. So for example, if something were to happen to Bitcoin, the existing UTXO set, basically the existing set of all coins and, you know, basically the addresses that people control, could technically be even hard forked or changed into another system. That you could take that approach, and if you had critical mass of users that, for example, needed to make that change for some reason, there's a way that UTXO set, that ledger, can move forward in another wrapper. So there are, I like to imagine tail risks of, you know, Bitcoin has had some bugs in the past. I mean, one of the funny stats is that it's actually has higher uptime than Fedwire since 2013. You know, and so if you go back to inception, I mean, Bitcoin had one inflation bug. I think it was 2010. Satoshi himself fixed it, and then there was a 2013 unintended chain split. They rolled that back and fixed that. There was also a pretty critical inflation bug that went undetected, in, I think it was 2018, and so that was not exploited but could have been. And so there have been a history of occasional problems that, if they were to be exploited or not fixed quickly enough, could cause a more damaging thing to the community, right? So I can imagine things happening to Bitcoin that cause it to have a multi-year setback, for example, or that can, you know, dampen how much it could reach. I think it'd be pretty hard for me to just not be interested in the technology anymore, or not want to hold any or not want to continue to explore the ecosystem. I think that's kind of, I think Pandora's box is open there, but there are, I can imagine scenarios where the network is crippled enough or stagnant enough or just damaged enough that I can no longer necessarily recommend it as a meaningful investment. That basically some of the worst tail risks or some of the worst outcomes have materialized, and that's the timeline that we entered, and it's unfortunate in that regard. So most of mine would be essentially technical in nature, that something technically happened to the network, because as long as it continues to operate as intended, I don't see why I'd not want to hold a non-zero amount in it. But there's also like adoption metrics you can look at, like how many on-chain addresses are there. If you start to see kind of a stagnation in people buying into it, then you can kind of just say, okay, we don't know if this thing's going to grow anymore. Maybe it reached total addressable market earlier than we thought, and I might still want to hold some, but then I might no longer recommend the amount that I recommended before, or things like that.
Yeah, those are great points, and I think as well for me, I kind of look at it from two different personalities. There's me as the financial activist kind of person who dove down the rabbit hole of what money really is and how the banking system works, and I felt like I was living in a big Ponzi scam, and it made me be like question what's the value that Wall Street brings to the world. What's the value in these financial markets that pretty much to me feel like casinos that drive the wealth inequality in the world to where it is now such a crazy like misrepresentation of like people to wealth, that it feels like Bitcoin is one of the solutions for the average person to be able to think clearly about they're protecting their savings and just simply save in a form of money that won't be debased. And for me, as like a financial activist sort of person coming from the Austrian economics interests and the sound money rabbit hole, the only thing that would like shake my confidence in Bitcoin as a generational savings opportunity for most Gen Zs and millennials is a change in the monetary policy, because that's the biggest network effect that for folks like me, that I mean, I'm probably not a libertarian like now, but at one point in my life I rebounded from being a complete liberal Democrat to like libertarian, like almost card carrying like Ron Paul supporter, to like now somewhere else. I'm still figuring it out, but like the one thing that stayed constant for me this whole political sort of like journey I've been on over the last 11, 12 years, 15 years, whatever, is the fact that the money system is not designed in a way to reward saving, and it's not designed in a way that is fair for the average person. Not to say that we need socialism to like redistribute wealth, but just that the fact that you should be able to work a normal job, save in your money, and then live a dignified life and be able to afford things like a home and not be constantly stressed about money. And the way that the current system is designed, it is constantly debasing your savings. And so Bitcoin, to me and to a lot of folks, they came to Bitcoin because this system represents a fix to the problem of a broken money. And it's going to take a long time for that to happen. But the long-term credible scarcity of Bitcoin, and the longer that Bitcoin operates without having someone or any entity be able to influence the monetary policy of Bitcoin, and that's the most important thing for us, because the problem is that they changed the parameters of the money and that they manipulate the levers of the money. That's what a lot of us believe. So on the financial activist side, so it's part censorship resistance. The thing that you were concerned about, Joseph, like government's not going to allow it. They're going to try to censor it. They're going to compete with CBDCs. We believe Bitcoin competes very well there. And also it's the whole design of the monetary policy of Bitcoin being a completely decentralized digital asset that has no centralized third party that can change it. So if that ever happened, it would definitely shake my confidence in Bitcoin being able to solve that problem for the world, because once it happens one time, it invalidates the thesis that Bitcoin is hard money for me. So that's the main thing. As an investment, though, like as an investor, I would probably still allocate some of my net worth to Bitcoin, even if that changed. I would just not be as passionately evangelizing it. You know what I mean? So like, but still I'm a realist and I recognize there's value in this asset. So even though it like would kind of dishearten me and cause me to not be as excited about talking about it and and spreading the word, I'd still want to own some, because like Lyn said, it is a Pandora's box, and I think it's just here to stay, and it makes sense to have a percentage of your net worth in it. Maybe I would sell a bunch and just keep 5% or something.
Yeah, I think encrypted peer-to-peer money is just a big thing, right? And I think that right now, I mean, Bitcoin has something like 95% of the proof of work market share of coins. I think it's by far the best shot that this space has towards, giving that at least an option for separation of state and money. And again, we don't have to think about the U.S. first. We can think about, the 180 currencies out there, people in all these different markets that have these inflationary issues. They have, half the world lives under authoritarianism. Kind of pick your problem. I think it kind of starts in the periphery and moves inward. And if you look at the Chain Analysis Crypto Adoption Index, I think they recently updated it. Out of the top 20 countries, so by different ways of measuring the percentage of people that are into crypto, and they don't really separate Bitcoin and crypto out. They just call it the Crypto Adoption Index. But 18 of those 20 are developing countries, and the other two are the United States and then I believe the United Kingdom. And I think on the last year when they did it, the U.S. was the only developed country on the list. The other 19 were developing, and I think there's signal in that, because I think it actually makes sense that if you have crappy currencies, you're more likely to explore non-state currencies or stable coins that are extra state. They're outside of your state, at least the hub that centralizes it. And so I think the technology is here to stay. And like Brad said, basically something with the monetary policy, something like I said before, like a critical bug that the network is just unable to kind of recover its network effect and enthusiasm about, could derail and present risks for, the adoption of this particular asset.
So it sounds like, so Brad, you're concerned about the monetary policy, and so which is to say debasement of the currency. Another way is to say that is inflation. And Lyn, you've done some really excellent work on showing that, there's some legitimate concerns about inflation going forward, both from energy and your recent piece on, let's say, fiscal spiral, too much government spending. And so if you have a world where, let's say, the currency is being debased, another way to say that again is inflation, and something like Bitcoin, something that's a bit a harder asset like that, or at least can't be easily debased, as they say, would be an attractive investment going forward. Is that, that I think that makes sense to me. I mean, um, when you have inflation, the value of everything goes higher. So if you have something like a private asset, it stands to reason it would go higher as well. And if the technology is there and is resistant, then that could make sense.
Yeah, and also like some people criticize that because Bitcoin is disinflationary, it won't succeed as a global form of money in the future because there's not enough of it, or the inflation schedule is too low, that it won't allow for capital allocation, efficiency, and credit creation, things like that. And I think like as we go forward with Bitcoin becoming more and more adopted as a reserve asset and a form of money for some people, that there will be forms of credit creation in the Bitcoin system. It won't be that the supply of Bitcoin gets inflated. Like as long as the monetary policy stays 21 million, and doesn't change, like the halving schedule doesn't get changed, like nobody's able to interfere with the monetary principles or policy of Bitcoin. They used to talk about this like 10, 12 years ago on the Bitcoin talk forums, like Hal Finney and Satoshi and others, the early folks talked about how you could see Bitcoin scale out via Bitcoin banks, where some people would choose to start Bitcoin banks with fractional reserve, with like a reasonable fractional reserve, and then consumers would just choose whatever risk they want. Like, do you want to use a bank that has a fractional reserve Bitcoin, or do you want to use a bank that's fully reserved, or do you just want to hold your own Bitcoin and use Bitcoin? So I think most likely what we're going to see is a combination of stablecoin creation using Bitcoin as collateral, which is kind of a form of credit creation. If you have a censorship resistant, blockchain native, smart contract based stablecoin system that's uncensorable and is truly decentralized, where you say collateralize 10 Bitcoin to generate $100,000 backed units, that is a form of credit creation. And if people accept that, it's almost like a digital form of Eurodollars. That as long as Bitcoin, oh, go ahead.
I mean, when you're moving, I mean, Bitcoin as an investment vehicle, as a, you know, like a digital gold or something like that, that's one thing. But when you're moving into the Bitcoin as a bank, it's part of the banking system or having its own bank, that's a whole nother ballgame in my view. Then you have to have concerns about things like deposit insurance or lender of last resort, things like that. Or you could just end up, otherwise you would end up at like something like FTX. You know, they were basically, you know, kind of like a cryptocurrency bank in a sense that kind of took someone else's money and just did whatever they want with it. There's a real trust issue there. Then you're basically coming back full scale to the fiat banking system.
I think it's inevitable, honestly. I think, like, the more I think about it, the more I think that it is inevitable that you can't stop people from trying to do credit creation. The only thing you can try to do is build it in a conservative way that won't cause systemic collapse. Like the way that they did this happened already. It happens right now. Like Tether basically Tether basically does credit creation with USDT, where what they do is they will create USDT back with Bitcoin. So Celsius, for example, took a $1 billion USDT loan from Tether, backed by $2 billion worth of Bitcoin. So Tether had 90,000 Bitcoin. They gave $1 billion of USDT to Celsius. Celsius went and then invested it and kind of, you know, did a whole bunch of risky things with it. But that kind of, yeah, that is conservative. Like they were able to successfully liquidate Celsius when the price dropped of Bitcoin. They were able to successfully liquidate and eliminate that debt, and like the USDT just vaporized. It went back into the USDT's treasury, and they deleted it. But that's what a conservative sort of form of credit creation and stablecoin system can look like. But what they did in crypto was Terra Luna, and Terra Luna it grew to $18 billion of basically vapor tokens. So $18 billion of credit creation that just blew up because nothing was backing it. There was barely anything backing Terra Luna, and it was just purely an algorithmic peg that was based on Ponzi-nomics. And there was nothing backing it of value. And then when people tried to pull out of it, the whole thing imploded. So, like, for sure, I think there's a lot of risks in trying to build fractional reserve on top of these crypto systems. And the way that they ended up doing it in DeFi and in crypto, for the most part, is the complete wrong way, and it causes massive losses, and people have lost their savings, and it's hurt everybody. So they rebuilt everything that was like toxic and wrong with Wall Street, that got regulated away in Wall Street, and they did it on blockchains, and the same thing happened. So I think if we do it on Bitcoin, it'll be more of a conservative, rational way.
And I think, I mean, this has already been proven out to some degree. For example, there's Unchained Capital. They've been around for years now. And one of their main services is that you can deposit Bitcoin and you can get a dollar loan collateralized by that Bitcoin that will be liquidated if it falls too low. And what they do is they use a multi-signature setup so that, you know, they hold one key. Basically, a multi-signature setup is, for people that don't know, let's say you do a 2 or 3 setup where it takes 2 out of the 3 keys to move that Bitcoin, right? It also means that if you have one of the keys, you can like identify that Bitcoin on chain. You know it's still there and it's not being rehypothecated. And so what they'll do is you deposit Bitcoin, Unchained gives you one key, Unchained holds a key, and then a third key goes to like an independent entity that is now rules based. And what that does is that allows you to borrow against your Bitcoin in a way that is, one, it's more risk controlled, and then two, there's essential proof of non-rehypothecation, right? And that basically that you're far less likely to have an FTX-like event with that setup than with say FTX, right? So I think the industry is going to move towards more proper controls, right? And I think that there are a number of say fully reserved custodians, could be Cash App, if you're using it more actively, it could be like something like NYDIG or Fidelity if you're using like institutional grade large scale custodians. So I think it's going in that kind of general direction, but there's always going to be some degree of counterparty risk if someone chooses to use that on that level. Well, I guess the
Why
one thing
don't
I can go ahead.
go ahead?
Oh, I was just gonna ask Brad a question. I was gonna try to play devil's advocate because it's the dynamic here is kind of like the almost 2 versus 1. One person asking questions and then two people answering questions. And so I was actually going to ask a question to Brad and play devil's advocate because it's something I've been analyzing, and it also ties into both the disinflation and the altcoin competition thing. So, for example, right now, one of the memes in the space is Ethereum and ultrasound money, that they've changed their monetary policy a number of times, and now they actually have less inflation than Bitcoin, at least less issuance. Some people don't like to call Bitcoin's thing inflation because it's already fully, if you fully dilute Bitcoin, it's not really inflation, but in practice it is. So new coin issuance. And so how do you think this plays out in the coming years? Like how are the market share is going to compete when you have one that's more centralized, but is using that centralization to lower its issuance, potentially even into deflationary territory, versus Bitcoin, which is kind of more taking its time before it becomes a zero inflationary asset?
Yeah, this is something I look into a lot. I mean, I spend most of my time actually thinking about this situation, about the altcoins, DeFi, Ethereum, other more so than I do about like learning about Bitcoin, because I've been in Bitcoin so long. And I think the real risk of Ethereum flipping Bitcoin and becoming the dominant cryptocurrency is Federal Reserve policy and regulation. Because if the regulators just continue to take a step back and they don't actually come in and stop these fraudulent Ponzi scams from causing huge wealth creation and then wealth destruction, they just keep refilling their coffers to be able to pump the price of Ethereum. Like most of the VCs and A16Z and the Paradigm and these venture funds and stuff, Coinbase, they're all pretty much aligned to the idea that Ethereum is where they can make most of their money, and the Ethereum ecosystem and DeFi. And so they've made billions and billions of dollars this last bubble because the Federal Reserve's easy money policies and ZERP and all of that stuff have caused just massive bubbles to form in risk assets. And I think that one of the strategies that central banks or banks in general, venture capitalists, sometimes nefarious, sometimes not, if you were to think that there's this fear of Bitcoin in, say, the central bank world, if they fear Bitcoin, they've realized they can't stop it. So what can they do is they can compete with it, and they can, like the Netflix example, they can try to build the Netflix. They can try to elevate the Netflix over the BitTorrent. And Ethereum is like the Netflix of this example, because if they can elevate through venture capital, Wall Street banks, et cetera, just like elevate the network effects of Ethereum, then that can compete with BTC. Like ETH can compete with BTC, because we know that like in the world we live in, the best choice is not always the thing that wins out. Unfortunately, like, there's better ways to have privacy on the internet, but instead we all use Facebook and Instagram and Twitter and Google. So we know that the Silicon Valley and Wall Street can amplify something and build something up to where it's actually not the best answer to the problem, where BTC is the best answer to the problem. But not a lot, like, so if you remove the the amplification of Ethereum by Mike Novogratz and Real Vision and all these, people that are focused on making money, because there's more opportunity to make money on these altcoins, like creating pre-mining and dumping altcoins on the market. If you remove that and you just start to look at the monetary policy, then it's obvious to anybody that's paying close attention that Bitcoin's monetary policy is superior. And the fact that they were able to change the monetary policy of Ethereum multiple times shows that it's not decentralized and it's not resistant to censorship. And it actually invalidates it as a sound money. And I think so, as long as we're in this really constrictive environment with no quantitative easing and risk assets are kind of being crushed, that actually helps us breathe and take a look back and look and analyze what actually happened, what's going on, what makes these things valuable. And it slows the whole pace of everything down so that you can, a lot of the investment interest came in to Ethereum through this ultrasound money meme, the EIP 1559 thing, where they purposefully tried to make the stock to flow ratio of Ethereum better than Bitcoin's stock to flow ratio. And a lot of us Bitcoiners didn't really believe that stock to flow ratio was an important thing at all. It was just kind of like a meme. But a lot of institutional investors came into Bitcoin through the stock to flow ratio, the Plan B stock to flow ratio. And then, had people that are like influencing thousands of registered RIAs and money managers pushing the idea that the stock to flow ratio was what was exciting about Bitcoin. That's why you should allocate to it. So then Ethereum said, well, we're going to make our stock to flow ratio better than Bitcoin's. And now this is ultrasound money. And that actually fooled quite a few institutional investors and high net worth individuals that don't really deeply look at an analysis of what's the difference between Bitcoin and Ethereum in terms of the currencies. So I do think that it was a more of a threat last year. I'm glad that the risk is being flushed out of the system and all this speculative stuff is being kind of like destroyed. And, there's a lot of nonsense that happened in this market in the last year and a half, 2 years. And it's actually good for us. I think there was a risk that ETH was going to flip Bitcoin last year going into the merge. If the Federal Reserve, if the Russia sanctions hadn't happened in January and the Federal Reserve hadn't started signaling a tightening and things like that to crush inflation, then I think maybe we'd be in a situation right now where ETH would have flipped Bitcoin already because the network, like the momentum was so strong that they've done so well at marketing that, and driving FOMO in institutions. You even had the Bank of America write a report last year saying that, if you're a pension fund with $100 billion, that, the yield on bonds is so low, you're getting nothing from it, that you should deposit your funds in Curve and farm 2% yield in DeFi. So, I mean, when you've got that level of institutional Kool-Aid drinking in terms of like putting significant capital into these DeFi systems to make money on Ponzi schemes, something's broken with the signal and there's a lot of noise out there. So actually the Federal Reserve kind of saved rationality in crypto markets. And that's why I'm kind of bullish, actually, that people will realize Ethereum is actually more like digital aluminum than digital gold. And we can be in a world where Ethereum, the network, has a lot of transaction value, and maybe all derivatives in the world, maybe quadrillions of notional derivative value is getting done over DeFi layers on Ethereum. But the ETH asset itself can be like digital aluminum and Bitcoin is digital gold. So even in the best case scenario, in a world where we don't have asset bubbles being inflated by easy money policy and 0% interest rates, Bitcoin shines and like it becomes obvious that it's the better asset. So yeah, the worst thing for this altcoin thing competing with Bitcoin is Federal Reserve policy, I think. I don't know what you think about that, Lyn.
I think that's a fair argument. And we're going on long, so I don't want to hold people up too much. But yeah, I think it kind of comes down to between, how tight something is versus how decentralized it is, right? So for example, Binance is a deflationary currency, but we all know it's centralized. Ethereum's on that spectrum as well, whereas Bitcoin, what you're optimizing for above all is that decentralization. And so I think it just becomes a matter of making sure people are aware of the differences in those protocols. But I mean, I'll point to Joseph to see if he has any last words or last questions or.
No, I really appreciate this discussion. Is very helpful in understanding Bitcoin and some of the technological innovations behind it. And I can totally buy that Bitcoin as an asset class, something that could hold, well, was, I don't know about hold value, but is worth something going forward. Um, but Bitcoin becoming a banking system, that I think is just completely different and has shown time and time again to not work very well. I mean, we've done this in the fiat system for centuries. You know, if you have a bank, then you have a centralized node. Then there are issues about trust. What are people doing with the money? Are they issuing? What are they issuing? So that's when things like deposit insurance come into play. That's when things like lender of last resort come into play. So it's an experiment that's been conducted throughout time across countries. So I don't think that's going to work. But as an
Sounds like
asset,
that'll be part 3. Talking about
but guys,
Joseph,
you've already seen tremendous implosions of stable coins, which are basically
yeah.
banks, and FTX, which is kind of acting like a bank, right? They were basically issuing their own tokens and taking in money from other people. So, you know, we don't really see that in the fiat system anymore, right? And that's kind of important.
Joseph, before we end this, like, how long do you think we have left to be in the vice here in terms of monetary policy?
How long? What?
How long left do you think do we have to sit in the vice?
Like how much longer of tightening? Is that the question?
Yeah.
Nah, I'm not really. So I I don't view monetary policy as being a major contributor to debasing money and things like that. I really think it's mostly fiscal policy. I mean, I think of deficit spending as printing money, and what the Federal Reserve does, I don't actually think of it. I mean, it is printing money, but in a sense, but then you're really also using that money you print to buy other money-like assets. So I think the Federal Reserve is unfairly blamed for things like inflation and currency deplacement. I place more of the blame on our fiscal authorities. If you're asking when I think the Fed will stop tightening, um, it, they seem committed to staying higher for longer, and that will change if they have enough political pressure to change course. At the moment, it seems like there's some dissent within the FOMC. Let's see how that builds going forward. It's not going to be a decision based on data. I think it'll be a decision based on politics, although data does have some effect on that. I don't know. Lynn, do you have any views on that?
I agree with you, and I also specifically agree that fiscal is the major force.
Yeah.
That was a big theme that I focused on over the past, you know, 3 years. Is the idea that, you know, when people saw massive QE happening, they were like, oh, you know, people said this before. They said, you know, 2008 was going to be inflationary, and my whole theme was like, no, this is different. This is actually fiscal combined with monetary. You know, monetary is just enabling the fiscal. It's a very different story.
Yeah.
And so
Yeah.
that's been, and that's still there. I mean, it takes a breather sometimes, but there's still kind of these structural deficits built in going forward. Um, and so I think it's going to be a long-term story. And I continue to watch the treasury market functionality to see to what extent they can continue to tighten. We just saw uh, manufacturing PMI came in, and it's below 50 now, so it's contraction. Um, and so I think we'll see as we go into 2023 how long they can stay tight um, while avoiding recession. You know, we have inverted yield curve, treasury market, liquidity issues. You know, PMI is kind of heading down to 50 or sub 50, depending on which one you're looking at. Consumer sentiment's really low. There are some counter cyclical things. I mean, Atlanta Fed GDP is looking pretty good for Q4. Copper to gold ratio is suggesting some degree of buoyancy, probably because of the weaker dollar, or at least the dollar that it came off some of its high strength level gave a little bit of a breather, I think, to global markets. So I actually think it's a really tough question for the next 6 months. It's you know, some things are, there are moments of time that are very clear to me, and there are other moments of time that are very unclear. And I think the next 6 months continues to be one that is very unclear.
So it's good for dollar cost averaging, Joseph. You'll have low prices for a while.
Yeah, it looks that way.
I know a well-known Bitcoin skeptic that told me if Bitcoin drops to 1,000, he'd buy like a bunch of
Oh
them.
my
I
God.
was like, oh,
I'd be backing up the wheelbarrow. I'd back up the skidoo there.
Strong support at $1,000, guys.
Yeah. All right. Well, thanks very much, guys, for joining. Joseph, thanks for your intellectual curiosity on Bitcoin. Sorry it took me so long to organize this, but I'm glad you're asking these questions and willing to have conversations.
Thanks so much for having me on the show. It's a pleasure to speak with you too.
Thanks, Lyn.
Yep. Happy to talk with you again.
Bye-bye.